Hey everyone, welcome back to Corporate Decoder, the place where we unmask the hidden stories in company filings. Today we're diving into Raymond James Financial Incorporated's latest report. And let's just say they've been busy refinancing their financial life. Alright, so what is the big news here? Raymond James Financial Incorporated, a pretty well-known name in finance, has updated their main credit agreement. Think of it like getting a new, better deal on a massive loan for the company. It is not just a small tweak, they've inked a second amended and restated credit agreement. And importantly, this wasn't just a minor update, it is shaking things up for their borrowing capacity. Before we get too deep, if you like getting these kinds of financial insights, make sure you are subscribed. Also, we have a fantastic community over on Discord, linked in the description below, where we chat about these filings and more. This document, a Form 8K, tells us about important events that happen to a company. This specific filing is all about a move that impacts how Raymond James can borrow money. It seems like they've decided to lock in better terms for a large chunk of their financing. Let's talk about what this actually means for Raymond James. They've essentially renegotiated their primary credit line. What they've done is extend the deadline, the maturity date, for their borrowings. So instead of needing to repay this big loan by a certain date, they've pushed that date further out. This gives them more breathing room and flexibility to manage their finances. This filing also touches upon their preferred stock. It is a way for companies to raise money by selling stock that has some features of both regular stock and bonds. The details here, like the 6.375% fixed to floating rate, mean that the dividend they pay can change over time, starting at a fixed rate and then becoming variable. It is a common way to structure these types of securities to adapt to market conditions. On the 23rd of September 2025, they updated a key agreement related to this. Now, let's get to the meat of the operational changes described in this report. The big news is in item 1.01. This section details their entry into a material definitive agreement, which in simpler terms means a really important contract. The company signed a second amended and restated credit agreement. This is a refreshed version of their existing credit agreement. Think of it like updating the terms and conditions of a significant loan. The original agreement was from the 6th of April 2023. Now, this new agreement, dated the 23rd of September 2025, comes with some pretty significant changes. First off, they've extended the maturity date for any money they borrow under this agreement to the 23rd of September 2030. This is a 5-year extension from the previous terms, giving them a lot more stability and predictability for their debt obligations. Secondly, and this is a big one, they've increased the total amount of money they can borrow under this credit facility. It is now a massive $1 billion. This means Raymond James has access to much more capital if they need it for growth acquisitions or to manage their operations, and they've secured this on apparently better terms. And here is the really good part for the company. They've also managed to get a better interest rate. The filing states that the applicable rate for interest calculations has decreased. This means they will pay less interest on the money they borrow. The rate now ranges between 0.000% and 1.300%, down from a previous range of 0.00% to 1.425%. This reduction is tied to the company's credit rating. So, a better credit rating means they pay even less. For $1 billion credit line, even a small decrease in interest rate can save them millions of dollars per year. This is a really positive sign about how lenders perceive Raymond James' financial health and creditworthiness. This deal was signed off by Jonathan W. Orlog Jr., who is their Chief Financial Officer. This is a standard procedure, but it underscores the importance of this financial maneuver. The filing also includes interactive data files, which are designed to make financial information more accessible and machine-readable for investors and regulators. These are essentially digital tags that make it easier to analyze the numbers. Now, let's put this all into perspective. Raymond James Financial is a pretty established player in the financial services industry. They offer a wide range of services, from wealth management to investment banking. This move to secure a larger credit line with better terms indicates a strategic decision by the company. It suggests they are confident about their future prospects and are preparing for potential opportunities, or perhaps just optimizing their cost of capital. Securing $1 billion credit facility at potentially lower interest rates is typically a sign of financial strength and good management. It allows the company to be more agile in pursuing its business goals. One of the key aspects to consider with any such agreement is the underlying credit ratings. The filing mentions that the applicable rate is determined with reference to the company's long-term debt ratings. This means that if their creditworthiness improves, their borrowing costs could decrease even further. Conversely, if their credit rating were to fall, the interest rate could go up, though they've locked in a maximum rate. Looking at this, Raymond James appears to be strategically strengthening its financial foundation. They're not just operating, they're actively managing their balance sheet to ensure they have access to capital and are doing so at a favourable cost. This positions them well in a competitive financial landscape where access to liquidity and efficient capital management are crucial for success. What does this mean for investors? Well, it generally reduces financial risk for the company. Having a larger credit line means they can weather economic downturns more effectively or fund significant growth initiatives without immediate reliance on equity. The reduced interest expense can also contribute to higher profitability, which is always good news for shareholders. However, it is also important to remember that a larger credit facility, even if currently unused, does represent potential future debt. While this renegotiation seems favourable, any significant drawdowns will need to be managed carefully to ensure they don't over-leverage the company. The fact that they've managed to get better rates is a strong positive indicator here. In conclusion, Raymond James Financial Incorporated's updated credit agreement is a significant financial maneuver that enhances their borrowing capacity and lowers their potential borrowing costs. It signals confidence in their future and a proactive approach to financial management. This is a credit to their financial team for securing such favourable terms on a facility of this size. Alright, that is our breakdown of Raymond James Financial's credit agreement update. What is your take on these numbers and what they signal for the company's future? Do you think this move positions them for significant growth? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community in the description for more discussions. Thanks for watching, and we'll see you next time.